In today's video, we're going to be breaking down this week's work for financial education and literacy, trying to get you on that debt-free journey while investing, and of course, making sure that you have the best financial content that you can. So let me know in the comments what you guys think, and I hope you enjoy the video. Just like many Americans, you might be focusing on saving money while eliminating your debt, but eliminating debt does not happen overnight. It might take years, even decades to accumulate it, but working out of debt, even on a lower income with the debt reduction plan, and that's exactly what we're going to be looking at today. It is going to increase your success and really looking at a timeline of when the debt can be eliminated in its entirety. If you start at 12 months, you can kind of work out from there, but I want to break down some of the steps that I do use when it comes to debt relief and really the debt associated with coming up with steps to strategize it. Now, the first one, looking at your budget and squeezing more money out of it. This is going to be a permanent, or really for some people could be a temporary solution. Looking at your monthly spending, seeing exactly where you can cut. This could be including making a budget, making a spending plan, using a budget tracking app, but making sure you know exactly where every dollar goes. That is one of the huge things. A lot of people overlook it. A lot of people, especially younger generation, don't want to work in a budget. They don't want the constraints. They don't want everything that comes. But when it comes to getting out of debt and being debt-free, looking for any opportunity that you can to cut spending, dedicating more money to eliminating that debt and getting rid of it as soon as possible. When you even start looking at small cuts, for example, if you find $200 that you're spending that you can cut out of a multiple of different ways, adding that into a budget, you're putting $2,400 every single year onto that debt, eliminating it much faster. Second one, automatically pay your debts. This is super important for really two reasons. Number one, you know that payment is made. Number two, you know that your credit score is not going to be affected by missing these payments. If you want to be free from debt, you have to make sure you put these on autopilot, guys. Even if it is just the minimum payment, looking at your credit cards, looking at, your student loans, looking at all of your bills, you have to keep track of the due dates, especially if you're paying off a bunch at once, which we're going to break down a little bit more in the video. Now, using debt management app, again, this is one that you can track progress, but you do have to check in with it on a regular basis. If you are using some of those debt tools that are really systematically trying to eliminate debt, does take a considerable amount of time, depending on how much you're throwing at it, which is adopting your payoff strategy. Now, we've talked about these two before. We have the debt snowball and we have the debt avalanche. Dave Ramsey goes debt snowball, which of course is listing all of your debts from the smallest to the largest, tackling that smallest debt first while making minimum payments on everything else. And as you eliminate that first debt that you do have, that smallest debt you have, it is going to give you a sense of momentum and really snowballing it into another debt. So what we mean by this is, let's say that first debt is $500 you have, and you're making minimum payments on everything else. And out of that, because you are making minimum payments, you have an extra couple $100 to put on there. As soon as you're eliminating and that first debt is gone, it snowballs to the next one and down to the next one and so on and so forth until all of your debt is eliminated. Now, the other methodology behind this is the debt avalanche method. This is the one that I use because I know numbers, and really when it comes to mathematics, when it comes to stats, it seems to work a lot better because you get more bang for every dollar that you're putting in there. So in this method with the debt avalanche, you are going from your highest interest rate, not worried about the dollar amounts, but you're looking at that highest interest rate and you are working down into your lowest interest rate. This means that every single dollar that you're putting towards that very high interest rate is going to help you pay less interest over time, even if you're tackling the high debt first. But the big thing with this one is the psychological aspect. If that highest interest rate that you do have is also the highest balance you do have, it might take a little bit of time to get that paid down or start moving the needle on that one, depending on how much you're putting in it. And that's where people can get a little bit more frustrated because they're not seeing the results as fast as they wanted to, that you could see in the debt snowball method. But it also makes a big difference as long as you're using one of these two methods and you're using it on a consistent basis. Guess what? You are going to join me in the debt-free journey right back here, and it will be completely paid off in a matter of time. Now, when we start talking about some of the creative ways that you can use finances to actually eliminate debt, first one is the balance transfer credit cards. Now, if you have, again, thinking of the debt avalanche, if you have credit cards that are 20, 25, 30, 35% interest, you could balance transfer, and some of the balance transfer cards do not charge you anything for the balance transfer. Or if you transfer to another card, you could have 12, 18, 24 months. That is 0% or 0 APR on those balance transfers. And of course, you have to make sure that when you're tackling this, you're not just moving debt and then accumulating new debt. This is the biggest probably myth or the fallacy that I see. A lot of people will move money to balance transfer cards that have that 0% with the best intention to unfortunately pay it off. When it gets to that point and it is on that balance transfer card, they never get to the point of paying it off. It starts accumulating credit again, and they find out the cards that they just balance transferred or consolidated now also have a balance. So they're kind of double dipping. Now you have more bills essentially than you did before, but it does allow you, if you are very, very focused on it and very dedicated to it, you can pay off your debt much faster at a much lower rate. And of course, you can pay it off and put extra money towards that, eliminating it as fast as possible. The other consideration for this is a debt consolidation loan. Now, again, when you think of the 20 to 35% interest rate on credit cards, debt consolidation loans run about 8 to 10% if you have good credit. Even if your credit is not quite perfect, you might be looking at a 12 to 15%, which again, when you think mathematically, if you have a card at a $10,000 balance, if your 25% interest rate is going to 12%, you're going to be saving and more money is going to be going towards the payment every single month. But also the big thing that I see with this and the problem with it is a lot of people will see the much lower payment of the debt consolidation loan. All of a sudden, they are only making that basic lower payment. So if the monthly payment on your credit card is $250, people are taking out debt consolidation loans for 7 years. Their payment is $145, and guess what? They only pay that $145. They're not snowballing and they're not moving that additional debt and eliminating that debt as soon as possible. They're sitting on it, and they're sitting on it for an extended amount of time. Now, of course, you could also look to credit unions. Credit unions do have fixed rate cards, which are considerably cheaper when you're looking at consolidation loans or those balance transfer cards, and they have no balance transfer fees. So definitely look out for that. Now, another thing that we're seeing, and it's really big right now, is either doing a paying off debt with a cash out mortgage refinance, which, like a lot of people, you don't want to get rid of that really low interest rate that you got a couple years ago. So instead of doing the cash out mortgage refinances, we are seeing the home equities or the fixed rate home equities that are taking money out there. So what they're doing is the debt has gotten to a point where they can no longer afford the monthly liabilities. It is getting out of hand. They need money and they need to refinance it. So Americans are taking all of this debt and they're rolling it right into all of the equity that is now built into their house, because the value of houses are at an all-time high, meaning the equity is kind of built in there. But essentially, the way that I look at this is if you're using your mortgage, whether it be a cash out mortgage or maybe it's a home equity, you are turning your mortgage into a really big liability. And of course, with all of that debt you're consolidating into it, it is another opportunity that financial institutions could foreclose on your home if you're not making the payment. God forbid if anything happens, I don't want you to lose your house because you had credit card debt, which is kind of crazy. Now, when we start thinking about the elimination of it, making extra money, this could be picking up extra hours at work. It could always be extra money with the side hustle, just like what we do here on YouTube. And if you like the content, definitely subscribe to it. But you could be looking at part-time job. You could be looking at extra hours. You could be looking at any way and any options that you can think of to generate additional income. And again, this could be something that is kind of short term. If you're making an extra $50, $100, $150 a month, that can go straight into debt, guys. That is going to eliminate it, lowering that monthly payment, lowering the interest that you're paying. And of course, eliminating that debt, being debt-free is the ultimate goal. Now, if it gets to a point that you need credit counseling, I am a certified credit counselor. It is something that I absolutely love to do. We do financial counseling and really coming up with budgets. I do a lot of it. If you need help, guys, definitely let me know in the comments. But a lot of nonprofits do it for free. You have to be very careful. There are a lot of debt management companies, a lot of debt management plans that charge you money, that try to help you or say they'll help you when it comes to finances, when it comes to interest, when it comes to fees. It's kind of crazy that I've helped a lot of people through my years without any charge, without a price tag, without charging them more money, just helping them systematically and holding them accountable to those debts. Now, when it comes to credit counseling, kind of goes hand in hand. If you do have collections, if you do have things like that, you can renegotiate some of your debts. Now, this is what a debt settlement company does, but guess what? You can do it yourself. you can call them, you can really negotiate your debt, accepting a smaller amount, because essentially either one, you're going to stop paying, the company is not going to get anything, or two, you can negotiate to make monthly payments or paying it off for a smaller amount, and they're going to get their settlement and they're going to be completely done. Now, again, you have to be careful with some of these companies that provide a service at a cost. So not only do you have the debt, but you're kind of digging yourself into a deeper hole with these debt companies. And some of them do work pretty well. And I know there's a few reputable ones out there, but overall, it's mostly what you can do for yourself. Now, in the final one, and this is kind of where the straw breaks the camel's back, discharge or debt or declaring bankruptcy. This is one when it becomes overwhelming, there's no reasonable path forward. Declaring bankruptcy might be your only option. This wipes out your debt, creating a fresh start so you can rebuild your finances, but it also tanks your credit for 7 to 10 years. It will severely damage your credit score. For instance, when I did work at a financial institution, if you had bankruptcy, they would not lend to you for the first 2 years after bankruptcy. So you were blacklisted from everything, whether it was a Chapter 7 or a Chapter 13, you were blacklisted from everything. Now, when it comes to the court-appointed repayment plans for some of the debt, that could also happen. People think going to bankruptcy, they're just going to wipe the slate 100% clear. If you do have a decent income and just can't manage your finances, I know people who have, one, been denied for bankruptcy. They went, the bankruptcy judge or the court said, hey, you make too much money, you're just not managing it correctly. We're denying the bankruptcy. We will not let you do the bankruptcy. And the other side of it is, hey, we're going to make you do these repayment plans versus bankruptcy. So we're not wiping everything clean. We're making the payments or making you pay the payment plan that is agreed to. The bottom line here, guys, you can plan to eliminate debt, and a debt elimination plan is exactly what I did years ago. I have my mortgage, which again, by the age of 50, it is going to be paid off in full. That is my timeline within the next 5 years. Cutting my monthly expenses was the game changer. When I started eliminating my bills, first we got rid of the credit card debt, we got rid of the student loans, we eliminated the card payments, we eliminated all of our credit card debt, all the variable expenses, and guess what? We are right down to just having a mortgage, and that is it. So regardless of where the interest rates are, doesn't really make a big difference because we're not borrowing anything. We have not borrowed anything in about 8 years now. So when it becomes too stressful, when you feel like you're stuck in your situation, there is a lot of things out there, including some of the financial educators and counselors on YouTube. So again, if you like the content that I'm putting out, definitely subscribe to the channel. Let me know in the comments what you guys think, and I'll catch you in the next video. How much do you know about your 401k? In today's video, we're going to be looking at some very common questions that Americans cannot answer when it comes to 401k and when it comes to 401k plans. So I hope to enlighten you with our first question, which is the most basic question: what is a 401k? A 401k plan is an employer-sponsored plan, and it is a smart way, and for majority of Americans, the absolute biggest retirement account that you will ever have. It takes money from your paycheck, puts it right into a 401k, and of course, it does have much higher contribution limits in comparison to the IRA accounts. Second question: what does employer matching mean? So with a 401k plan, this can mean a variety of things when it comes to matching. Now, if your employer matches a percentage, meaning that you can contribute 4%, your employer will match that 4%. You will get a dollar for dollar match up to that first 4%. Now, we've also seen a couple variations of this, including a donation that is up to a certain dollar amount, where regardless of what you put into your 401k, your company's going to kick in $2,000, $2,500, or some of them match like 50 cents on the dollar for the first $5,000. There's a lot of different ways. So understanding the benefit and understanding exactly how your company matches that 401k is imperative. Now, the third question: is there any contribution limit with 401ks? Like we just talked about, yes, there is. As it sits right now, it is $23,000 for 401ks. Now, that is your employer contribution. If you're over the age of 50, you can also contribute an additional $7,500. Now, this is adjusted every single year. The total contribution that can go into a 401k is capped at $69,000. Now, that is a contribution or a cap that is built by the IRS, that is built by the government. And that $69,000 in total is a combination of your employer contributions and your employee contributions. So remember both of those. When you are only capped at the 23, employers can still contribute a lot more money to that 401k. So where should you begin, or when should you begin the 401k account? Simple question to this and simple answer: immediately. Any place that has a 401k plan, you need to be investing if you ever want, a snowball's chance in everywhere to go ahead and retire. This again is the biggest retirement account that we do see for individuals. So the more that you can afford to this and putting that 15%, that is really the ultimate goal. It has been proven time and time again. If you're contributing 15% of your income, even at a lower income, a middle income, a high income, if you're putting that 15% contribution in there, it does make a big difference, and it will compound and it will snowball through your entire working year. Now, question number 5, what is the tax difference between a Roth 401k and a traditional 401k? Now, the big one with this is how it is taxed. So when we start looking at the traditional 401k, which most people have availability to, when you're putting money in there, you are putting in after tax dollars, or excuse me, those are pre-tax dollars, meaning you have never paid tax on that money. So think about it big picture. If you make $100,000, if you put $10,000 into that traditional 401k, you are only paying tax on that remaining $90,000 that you have. Now, the other side of this is the Roth 401k. Same scenario, you make $100,000, you put $10,000 into that Roth 401k, you are still paying tax on $100,000. The Roth does not have the tax treatment that we see with traditional accounts. So the theory behind this, and really the big concept, is you can get a tax break today, but you're gonna have to pay taxes later, or you can pay your taxes upfront today to have beneficial tax-free growth later. When you look at apples to apples, the Roth variation always comes out on top because of the compounding interest that is in there. So you think about, again, putting that $10,000 into both of these accounts. If they're growing by 10%, when you start getting to the point of getting taxed down the road, and if you get this account to a big number, I'm talking $2, $3, $4 million, there's going to be a point where your tax bracket is going to be and can be higher than your working years, depending on exactly where you are. So looking at question number 6, are employers required to offer 401ks to their employees? The answer for this, many states, yes, they are required to. Some states there are not, and they do not require automatic deductions, which again, you're gonna see this is changing in the future. A lot of places, and I know government regulation, I don't know what's gonna happen when Trump takes office, but they were talking about using a couple tax benefits and also making it mandatory for 401k contributions. So if you're working, you're putting a certain percentage towards retirement accounts, because what's happening as we see it today, a lot of people are working their entire working life, they're getting to retirement, they don't have any money saved, because while they were working, they were not making any contributions at all into the 401k, even though it was offered, even though there was a match, there was no and really nothing that was compelling them to save any money. So question number 7, I saw what happened in 2008 and 2009 with the 401k accounts. Is it a risky investment? Now, if you think of when the housing market really took a dive, investments took a dive, we've seen them lose about 30 to 50% of their value. Now, since then, if you stayed invested, you would be up tremendously from that point, even though the market does have some fluctuations. Anything major like that, we've seen the exact same thing kind of happen with COVID. I mean, the year after COVID, we've seen a pretty big decline in the market. It happens. Market fluctuation is not looking at a year or even looking at a couple years. It is looking at 5 to 10 year spans. When you start looking at 10 years, 20 years, 30 years, is it a risky investment? No, it is, again, where a majority of people are. There is no question, though, in the market, your money can be at risk. Good news is they have a lot of, high risk funds. You have your medium risk, you have your low risk. Even some of the 401k plans that are offered at my employer do offer bonds, which of course are almost no risk, because of course, if you're buying government bonds, if you're buying corporate bonds, there's a little bit of risk, but not what you're gonna see with investing in the market itself. But when it comes to big picture, investing in the market is the way you see the growth. Taking the risk reaps the reward when it comes to investment accounts, when it comes to be invested. And again, thinking about something like the S&P 500, average return has been around 10.4%. So if you put it in there for the last 40 years, your average return, give or take a couple, is about a 10% return in that investment account. Even though there's risk, yes, there can be mitigated by really making contributions and doing dollar cost averaging, which is exactly what you're doing when you're making those contributions every 2 weeks with your payroll cycle. Question number 8, how much should be saved in my 401k? Again, this really depends on one, how much you can set aside for retirement, how much you can afford. Number 2, what is not going to cripple your lifestyle? So what I don't want to do, and really the way that I ballpark this is if your employer offers a match, again, let's say they offer that 4% match, you are going to get that 4% match. That is where you're going to stop unless you have all of the high interest debt completely paid off. It is eliminated in its entirety. What I see happen in being a financial counselor, I do see this quite a bit. What happens is you start worrying about the high interest debt. You're doing the snowball method. You're paying down that debt. It's taking you 3 years. It's taking you 5 years. During that time, you had a couple setbacks. Well, now you're 7 years in, you still have a little bit of debt. Those 7 years have been zero 401k contributions. Those 7 years have been zero matching contributions at that time. And there's going to be a time where, for a lot of us, people are going to carry debt. As long as you're getting at least the very bare minimum of the matching, you're at least making some progression, you're saving something, and you're getting 100% return on your money. Even when you think about it mathematically, if you're getting 100% return on your money, high interest debt is at 30% with those credit cards. You're even getting a better return from putting money in that 401k versus putting in that high interest debt. Now, as much as I hate high interest debt, that should be absolutely the next thing you're looking to eliminate. Once you start a small emergency fund, then go right into really knocking out that debt. Question number 9, what age can you start withdrawing from your 401k without having the penalties? That is right. This is one. It is 59 and a half as it sits today. They can always make some changes, which they are changing the RMDs in the future. And we know even, I believe, 2033, it was talking about making RMDs mandatory now at age 75, which I believe this year it now goes to 73. So it is making a difference. But 59 and a half, you can start making money without the additional penalty that is taken with the early withdrawal. So let's say, for instance, you're 55, you take money out of your 401k, you are not only going to pay taxes on a traditional 401k, but you are also going to pay an additional up to 10% early withdrawal penalty out of that 401k. So they really sock you with a double kind of tax there. You do pay the penalty for putting the money in there. And of course, if you do take it out of a Roth account, you can take contributions out tax-free. And of course, you got to meet a couple other stipulations like the 5-year rule, but you can take contributions out tax-free. If you take any of the growth, they're going to tax you on there. So what is vesting? What is vesting in a 401k plan? This is question number 10. When it comes to vesting, this is up to your employer. It is the way the employer sets up the 401k plan, meaning for a majority of people, it is a benefit that you have to be there for a certain amount of time. For when I worked at my current employer, it is a 2-year vesting period. When I worked at my previous financial institution, it was a 3-year vesting period. So essentially, if you're putting money into that 401k and you have a 3-year vesting period, if you leave anytime before that 3-year vesting period, all of your employee contributions are forfeited in their entirety. They are keeping all your money. They are not giving it to you. They are not going to allow you to move it. It is going to be taken back from the employer. Now, your 401k, your contributions, those are always yours, but the employer portion will be pulled back and you will not have availability to it. Question number 11, what fees are associated with a 401k account? There can be a multitude of fees. You have to be very cognizant of it. Not only what you're investing in, what are the management fees, what are the maintenance fees? You should expect to pay around 1% to 2% of the total assets of your 401k. If you need a management and if you want a financial advisor, 1% is usually the normal. Now, if you put it into index funds, if you put it in the ETFs, usually the fees are far, far less. When we start looking at something like our S&P 500 funds that have a 0.02 or 0.03 fee ratio, it is super cheap in comparison to having those funds managed. Like I said, most financial advisors, it is 1% that you're paying them essentially to babysit your money, depending where it is and how many changes they make. Question number 12, can you and how do you take a 401k loan if you need emergency cash? Guys, when it comes to a 401k plan, this again is going to be up to your provider. It's also going to be based on a couple different things, including one, what is the balance you have in there? Some of those let you borrow up to a certain dollar amount. So again, if we have $100,000 in a 401k, you could only borrow 30% of the value, or they have a dollar amount cap. Some of those are 30,000, some of those are 50,000, and this is all based on the vested balance. Again, there could be some different things. They could have, hey, if you take out a loan and it's paid back from, withdrawals through your payroll, you're not going to have to pay interest. Some of those do accrue interest. They have an interest bearing up with it. You might take it out for 3 years, you might take it out for 5 years. So yes, you can take out 401k loans, and most of them do it without really ransacking and really crushing your 401k portfolio, but you do have to pay the money back, or it's going to be considered a withdrawal. If it's considered a withdrawal, even if you leave the employer and you have a loan outstanding, they will usually call it. You might be hit with that 10% extra penalty. So what happens to existing 401ks when you change jobs? This is a huge one, and this is one that a majority of people do forget. Good news is with most 401ks, you can roll them over into a new 401k. If you don't have that ability, which I did not, I had to move my 401k into a Roth IRA because I could not roll my previous employers to my new one. Now, another thing to note is money that is vested, you can move it. Money that, of course, is not vested, you cannot move it. But something to really remember is you don't want to forget about it. There is estimated, I believe it said like 300 something million dollars. That is in nothing, really not invested in anything. The 401k plans are not managed. They're older 401k plans. They're not being managed by anyone. It's individuals that left a company, had smaller balances in there, and they never moved the money. They never took the money. They never rolled it over. Now, what I learned when I left my former employer is if your balance is less than $5,000, they will just cash it out. Here you go. Here's your rollover check. You have 60 days to redeposit it, or it is going to be a taxable event. And of course, I had to move it again into that Roth IRA. Now, a lot of times, if it's more than $5,000, they will let you keep it exactly where it is. Now, you have to be careful with this too, because I've also seen some 401k providers that have moved the balance that you had into cash, meaning the money just sat there. The market's going up, the market's going up. Last year, this year, the market is on fire. You would have seen zero growth because that 401k balance in its entirety is just sitting there. So what happens with question number 14 if an individual passes away that has a 401k plan? Now, this is a very common question that we get. When someone owns a 401k plan and they pass away, there should be beneficiaries on there. Double and triple check your accounts. I'm talking checking accounts. I'm talking banks. I'm talking HSA accounts, your 401k accounts. Make sure you have beneficiaries on there. We want to make sure that the money is not going to probate court like it does in Michigan. Probate takes a significant amount of the money that goes to probate. And of course, your family, your heirs, whoever's intended to receive this money is not going to get it. Now, if you are not a spouse, spouses fall under a special set of rules. If you're not a spouse, you must also withdraw the money within 10 years. So think about this for a minute. Spouses can roll it into new retirement plans. There's a couple different things if you are a spouse. But for instance, let's say you pass away, you don't have a spouse, you leave the money to your kids. Your kids would take that as an inherited IRA. They would have 10 years to use the money. So if you think about an individual, depending on the balance you have in this this 401k account, if it's sitting, let's say $2, $3, $4 million, you only have 10 years to get rid of that. You want to talk about the taxes. If you're sitting on $4 million in a traditional account, you could mess up and really throw your kids. I know they're getting a lot of money with the inherited IRA, but overall, you're going to throw their taxes into a tailspin for a decade because of what is going on with that, with those inherited IRAs. Now, question number 15, we get into what is a hardship loan or a 401k loan. This can be a couple different things. Now, it is a very tough position where if there is a financial hardship, this is an emergency funding situation that they use. It is used to cover medical bills, make a house or vehicle payment, but a lot of people also use them as first-time home buyers, use them and use the money to do a down payment on the house, which essentially you're sacrificing your retirement account to put a down payment for a house. Now, of course, if you pull out money in a hardship loan, it could be taxed. It might be taxed. There could be penalties. You have to make sure, and again, run through it with your 401k provider and know exactly what you have going on. Question number 16, can you decline having an employer provided match to the 401k funds? Don't know exactly why you would do this. If you don't accept money from the employer offering a 401k fund, you can do so. You can deny the match if you don't want the match. However, there's very few instances that this would ever make sense. If they are giving you free money, take the free money. If you decline the matching funds, you're giving up free money. You're giving up the ability to build and really develop that 401k plan because you're giving away that money. Now, this is the big one that I get, and I see this one a lot. Can you set up a 401k plan if you are self-employed? If you're self-employed, you can set up a solo 401k plan, and they're built for this exact reason. If you are specifically self-employed, you can set up your own 401k plan, and you can make contributions, total contributions right now, up to $66,000 per year, $73,500 if you're over 50 years of age. You can set up your own 401k plan as an independent or a solo person. Now, do employers automatically enroll you in a 401k plan? For a majority of places, the answer is no, but some of them do by default. So for instance, what we do at my financial institution is every single year you get 1% increase. It coincides with your raise. So if you get a 3% increase in raise, your 401k gets bumped up 1%. You're making and saving 1% of the 3% you got. And of course, this goes up to 10%. That is at the point that the employer stops automatically increasing every single year, increasing your contributions into that 401k plan itself. Now, of course, you can opt back in for a majority of different times if you want to, but automatically, you know, a lot of people will do the 1%, then they go ahead, they reduce the contribution limit back down to 0. Then of course, the next year it does the exact same thing, goes back to the 1%, and it goes back and forth every single year. My best efforts in really getting people, again, to get that match at the very bare minimum, making sure that they have it. Now, question number 19, and this is our final question. Do I have different 401k options from my employer? Answer for a lot of people are going to be no. A lot of places are just traditional 401k plans only. There's no other option, but you can have a bunch of different investments. And some, like including mine, they offer a traditional 401k and they offer a Roth 401k. So you can actually get both of the variations in there. Now, you also do have to know what your company invests in. So looking at what we had in my 401k specifically, we had a lot of target date funds. We had some large cap, mid cap, small cap, international bonds. There was a whole bunch of things in there, but knowing what you're investing in and doing your research, a lot of people just put money into the target date funds. A 2045, a 2055 fund through Vanguard does pretty well. But when you look in conjunction to a lot of the other things they offered where you could build a very similar portfolio that would do and has performed way higher than the target date funds. I'm talking over the last 10 years, it's outperformed about 10 to 15% with versus those target date funds, which really does make a big difference when it comes to building this out. So overall, guys, I hope I answered some of your 401k questions. Again, when it comes to 401ks, when it comes to investment accounts, I do get a significant amount of questions about them on a regular basis, not only in YouTube, but also in the professional career. So guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. People who are wealthy do things a lot different than you and I do. Now, in today's video, we're going to be looking at 12 things that wealthy people do a little bit differently. So hopefully you can make some notes on this, take advantage of what they're doing. When you think about building wealth, it's not about building luck. It's really not about having a high-paying job. It is about how you manage your wealth and how you build it, how you create it. The truth is super simple as saying the rich do something different with their money. And of course, that's what we're covering. So looking at our first thing, willing to sacrifice money for time. Now, a lot of people, including myself, really took this for granted when I start thinking of the ability to make money and the ability to utilize my time. If I have to spend money and really putting a price tag on your time itself, as rich people do, it is one of the most valuable things. Time you can never get back. There is time to make money. There's time to really spend money. And sometimes it does take spending money to make additional money. For me personally, when I started doing YouTube and I started doing some of my edits and some of the videos, I hired someone to do my videos for me. And you know what? That was an incredible time saver. I am absolutely horrible when it comes to editing videos, if you've watched any of mine. But when I turn it over to a video editor, they can work their magic. When they do the editing, meaning I was spending probably 5 to 6 hours editing a video. Might not get that many views overall with all of the time I put into it. So definitely putting and sacrificing money for the time that I'm getting back from not editing any of these videos makes a really big difference. Now, the average person really overwhelmed by chores, overwhelmed by a lot of things that are taking their time away. So you have to really break down, how much do you make an hour? What is your time worth? What is the value of your time? If I'm spending 5 hours every single day editing videos, it is not worth the time that the videos and how much money the videos are creating or really achieving for me to do it myself. It is not worth my time at all. Now, the second one, reading and learning all the time. When it comes to education, it does not stop at school. However, it is estimated that 54% of people never read a book after they finish their formal education, which is incredible. When you look at reading books, going to seminars, watching YouTube videos, looking at role models, using mentors, there are so many ways that you can really set yourself up financially for success, including financial literacy, education, and all of it can be done for free. When you start looking at YouTube, when you look at different places, make sure, however, you do know the source of the content you're getting and also the quality of the content that you're getting. Now, when it comes to being wealthy, associating with the right people, they always say, show me your friends and I'll show you who you are. That is really the average of the 5 people that you associate with most. That is going to be your kind of fan base. The rich consistently select their companies and also the individuals they spend time with. If you have someone that can really build you up, that can help you, that can really grow and develop you through the power of networking, it is going to be a game changer for the rest of your life. Now, when it comes to taking risk, this is something where people really do decline. I see this being in a financial institution where people will leave money in a savings account that yields almost no return. They don't even want to move it to CDs because they don't want the risk, they don't want the tax liability, and they don't want to lose any money. You have to realize when it comes to wealth creation, when it comes to really wealth generation, there is going to be some sort of risk. Whether it is investing in something like the S&P 500, if you're putting it into bonds, they don't want to think about the consequence or the possibility of something happening that they won't have access to the funds, or they really might lose money, leaving the opportunities on the table for you and I to really take advantage of. Now, when we start thinking bigger picture, they prefer to save and invest. This is something that changed for me probably about 10 years ago now. It wasn't really about focusing on exactly what I was spending, but it was the ability to almost not spend. For me personally, I'm very minimalist when it comes to buying anything. And if I do buy something, it is very on the frugal side. I do a lot more research about it. I find even if it costs a lot more expensive, that it's going to last and really have a lot more of a quality than buying the quantity of things. Now, this makes a big difference. Now, it says nearly 6 in 10 Americans are uncomfortable with the level of emergency funds. Guys, we're talking 60% of people are not happy with just the basic emergency fund. For me, I scrimp, I save. I know when I have a bill that's due or if I have something that I want to accomplish, I cut out pretty much everything. I cut out going to get coffee. I cut out going to get snacks. I cut out everything. We make our lunches at home. We make our breakfast at home, even dinner. So we're cutting out to eat food. And of course, that cuts a really big chunk out of the budget when it comes to the food budget. Now, thinking of diversification, we're talking here about the multiple sources of income. When you think of a YouTube channel like this, it is generated through AdSense. Definitely subscribe to the channel and let me know what you think about it. But it is one source of income. When I start looking at, holding mutual funds or holding stocks, holding bonds, holding anything that is going to yield me a regular return, even having money in a high yield savings account, giving me interest back, the interest adds up. It starts snowballing as you start accumulating more and snowballing the interest, even saving in that high yield savings account. With my emergency fund, if you have $20,000, $30,000 in there for a savings account as that emergency fund, guys, if you're putting at 4.5%, 5.5%, you're getting a good return. The return that I got last month just on that high yield savings account was about $140. That pays my cell phone bill. That pays my internet bill. You know what? I'm covering my bills on a monthly basis just from the income generated from sitting in a high yield savings account. When you start putting in what you're getting on CDs, it's playing the opposite side of the field. Now, what I mean by that is there's a point where you have a mortgage, you have student loans, you have credit card debt, you have auto loans, you have personal loans, you have all of this that you're paying for. Interest is coming out of every single payment. You are losing money and essentially giving away your time, giving away your money to financial institutions to have the things that you have in life. Well, the other side of it, or really playing the other side of the fence, is when you're starting to save money and when you're starting to accumulate wealth, you're being paid interest in return for what you do have on deposit in different places, and what you haven't invested, you are getting money back. So it is kind of the flip side. When you look, 52% of Americans now have a side hustle of some sort to create multiple streams of income. And God forbid, if anything should happen to your primary source, let's say you use your job, you lose your job, you're disabled, anything happens, you do have something kind of supplement some of the income when you live within your means, and making sure that you can supplement again if anything should happen. And of course, touching on the point of living within your means, this is something that keeping up with the Joneses, lifestyle creep, regardless of what you want to call it, it has really taken a huge impact on America. And really overall, looking just at credit card debt alone, we're at about $1.14 billion in credit card debt, which is crazy. Not bragging about the money, but making sure that you have, and we do, a lot of unnecessary spending. Some people I can see, yeah, if you have to use a credit card to supplement income because you're buying food. What does it break down to? Where are the needs and wants categories? What is it breaking down to? Could you get a less expensive car? Could you get cheaper insurance? Could you get a cheaper house, a cheaper apartment? Are there things in your life that you could exclude or even kind of downsize, even if it is for a minimal amount of time, so you can get everything really in check and living below your means? Now, of course, when it comes to planning this out, developing a plan and following to it. Money is not made overnight. It never is. So the rich have a very well-defined financial objectives that they're working on. Now, I did this again a multitude of years ago, and figuring out exactly when I want to pay off my house, how much money we want in retirement accounts, what is it going to look like? We might be 10, 15, 20 years away from that. But you know what? I have a plan. It's on sticky notes. I have a plan in mind of exactly what we're going to do, even converting some of our 401k money when it comes to IRAs, converting it to Roth money, paying our taxes when we have a lot less earned income. So definitely coming up with a plan makes a big difference. And when it comes to everything said and done, knowing how to give. Dave Ramsey talks about this, being generous and being really generosity. When it comes to management of wealth, most wealthy people do give a lot of money away, not only for the tax benefit, but it does really go against common knowledge to give your money away and be generous when you could just hoard it yourself. But when you look at people like Warren Buffett that is leaving 99% of his entire wealth, his entire fortune to charities, that is the way to really do it. And honestly, if you can give time, which I love donating time and I love doing things through nonprofits, through our churches, a lot of different ways. But if you can give money as well, and really the combination of both of those do make a really big difference. Now, of course, when it comes to building wealth, lifestyle inflation, we talk about lifestyle creep, we talk about keeping up with the Joneses. This is one of the absolute biggest detrimental things that I do see. You have an increase in income, you get a new car, you get a promotion, you got a bigger house. As life continues to get more expensive, people aren't keeping really the status quo, which is exactly what we did. And it allowed us to be almost completely debt free, short of having the mortgage, because we do not partake in lifestyle creep. We do not look at keeping up with the Joneses. Even my wife and I, our cars are roughly almost 8 years old now. You know what? They still got a lot of miles left in it. We do regular maintenance on them. Anything that breaks, we fix it. And you know what? Over the last 11 years, we've went through some promotions, went through some different jobs, even, making a lot more today than we were 10 years ago. We have the same house. We have very similar expenses. I know consumer price index, the cost of living does go up, but overall, when it comes to breaking it down, we make sure that we're tracking our spending. We know how much we're spending on food, what we're spending on groceries, where exactly every dollar is going. And it makes a big difference when you make a budget, when you do your lifestyle plan, when you do your spending plan, whatever you want to call it, you got to know where the money is going. It really comes down to the fundamentals of knowing when you're putting a dollar and spending a dollar, where's the other place, that you're not putting that dollar, that you don't have the ability to because you are spending it. And the final one I'm going to leave you with is the long-term goals. When you think about wealth accumulation, it's not a year, it's not 5 years, it's 10 years. When you start thinking of true wealth accumulation, you're looking at 20, 30, 40, 50 years down the road. If you started at 18, investing 15% of your income, it is estimated that you will have $3 to $5 million in an investment account, just keeping that status quo for an extended amount of time, which is kind of incredible to think because you're not changing anything. So if you move to a new job, you get a big promotion, you're making more money, it is 15%. A couple years later, you get another promotion, you get a better job, you're making a lot more money, you're set in your career, it's still 15%. Now you are 50 years old, 60 years old, getting ready for retirement, still putting in that 15%. Boom, you have $3 to $5 million out there, which is kind of crazy. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. As a financial counselor, I found it very interesting when you see a lot of people that have all of their finances in order, or you see the other side that is really struggling with finances in general. Now, when it comes down to this, it is the consistent habits that I'm going to be sharing with you today that I see from those individuals that have all of their finances in order. And it's not incredibly complex. You don't have to be a brilliant accounting major. You don't have to be a financial wizard to get these right. And if you do put them in place, you're going to be a lot better off financially. So the first one we look at is tracking your spending regularly. This, of course, creates an accountability piece. When you have money coming in, you have money going out, and then you have your third bucket with what you have left over for the month. A lot of people don't even know the difference or don't even want to know the difference between needs and wants. They don't want to know the difference between what's coming in and what they're actually spending because, again, they don't want to categorize or they don't want to spend the time doing it. But it is imperative. It gives you a very defined and a very clear picture of your financial habits when it comes to breaking these down, and you can really make a lot of smarter decisions or even the realization when it comes to this, well, of where you're spending money and where you have the ability to cut back on. Second one, creating a monthly budget. This kind of goes hand in hand with the first one. A budget is the roadmap to financial success, and it cannot be, too time consuming. People get crazy and get caught up with this and get caught up with the budget. People don't want a budget. They want a spending plan. They want a free lifestyle. They want whatever it is. It makes a big difference. If you're living paycheck to paycheck, if you have a side gig, if you're looking at, having a side hustle, keep it simple. Put what money you're making, where your expenses are going. You don't even have to do it to every single dollar, to every single penny. You can, of course, if you want, but knowing exactly what you have over left in that last bucket, again, is going to be imperative. When it comes to things like groceries, when it comes to utility, when it comes to entertainment, these are things that can vary wildly, and knowing exactly how much money you can put towards those can make a difference when it comes to financial. Any leftover money, you can put it towards building that emergency fund. You can use it for debt repayment, or you can use it to investing. Now, of course, the big one that I really stress with everyone, and our third one, is automatic savings transfers. We talk about this a lot when it comes to 401ks, when it comes to saving, when it comes to building up that emergency fund. It is imperative that you automate your saving transfers. It is super, super easy to pay yourself first, removing really the temptation to spend money before you have availability to it. So if you think of 100% of your income, if you're saving, 5, 10, 15% right off the top, 85% of the income that is left at that point is what you have to run and really know exactly how much you're spending. It's kind of crazy, but it does make sense, and it does make sense. And it also does make it super easy when it comes to automating it because you can kind of set it and forget it. Don't even have to worry about it. Now, the fourth one, we get into the investing aspect, which is the diverse portfolio. This is really the key to any good money management. When you're starting to look at investments, when you're starting to put that 15% away, has to be into not all in one nest egg, but kind of broken up with a diverse portfolio. And we talk about the 3 ETF portfolio. So what we do with this one, and this is how I personally do kind of talk about the financial education piece, is the first part is going to be our foundation. So this is going to be an S&P 500 index fund, regardless of the variety. Whatever you want to choose, this is going to be your foundation. The second one you're going to choose is a growth ETF. This, of course, is going to be the one through the next 10, 20, 30 years. You're going to see a majority of growth. A lot of it's going to be focused in the tech sector. Again, you can really choose whatever you want. And the final one is going to be an income ETF. This could be the HD. This could be a lot of different income ETFs. And overall, the mix of these is going to be dependent what percentage you're putting in on what portfolio you're building, and that is going to be very dependent on your age. Now, a lot of people say to diversify it even more than that, doing stocks, doing bonds, doing real estate, doing crypto, mutual funds, doing ETFs. There are so many things, but when you start thinking about the simplification of ETFs, exchange traded funds, that's exactly how I build my portfolios and how I recommend building portfolios. Number 5, we get into living below your means. This is something that I feel was lost years and years ago, is if you make $5,000, you cannot spend $6,000. Mathematically, it does not work unless you're the United States government and you can just go ahead and raise the budget up to, trillions and trillions of dollars. But for a majority of us, you have to stay within and really live within your means. If you're supplementing income for credit card debt, you're going to run out eventually. You're going to get to a breaking point. And I feel like that's where a lot of people are right now. There's no room for savings. There's no room for investing. There's not even room for the occasional splurge or even the debt repayment. People are getting to the point where the bills are getting too high. The monthly liabilities are overriding exactly what you can in the running in the red. It cannot last for a long time. You have to live within your means. Even if you're living, very, very close, let's say using 95% of your income, living within your means and not borrowing to supplement the income is an absolute game changer. Now, the sixth one we look at is unnecessary debt. This is one that I talk about when I have people who borrow money. How are you going to pay it back? That is a question that I very, very rarely ever get an answer to. We had an individual coming in looking to do a wedding, wants to borrow $25,000. They're going to pay it back over the next 7 years. So think about that for a minute. $25,000, nice to have. Yeah, great wedding. You're going to spend your first 7 years married in debt with $25K in debt for 7 years. How are you going to pay this back? You are starting your marriage in debt. It increases the financial stress of making those payments and really takes your finances off course when you're having an absorbent amount of money that is going into something that is going to be one single day. Are they going to recoup the cost? Probably not all of it. Then when you couple in student loan debt, you start putting in, the rent or the mortgage payments, you start looking at car payments, you add in insurance. That is the reason why when it starts getting into the high interest debt, especially that credit card debt, it is imperative that is what you eliminate first. Living within your means gives you the ability and gives you the income to repay and eliminate that debt in its entirety. Everyone that I see that is financial savvy, everyone that I see that has very strong financial habits does not carry high interest debt because it is so expensive. Now, going back to our scenario of the wedding, number 7, planning for big purchases. This is, again, something that I feel like was lost years ago, where when you think of, let's say, for instance, I own this house, there's going to be a point in time I need a furnace, I need an HVAC unit, I need a roof, I'm going to need windows. Setting those savings goals and really setting it aside, putting, let's say, $100 a month into a savings account, that is our house fund. That is exactly what we do. So over the course of, a couple years, I might have $5,000, $10,000, $15,000 saved up in there. It really makes it easy doing it in very small segments, very small amounts to manage savings and really targeted to the point of when we need windows, when we need a roof. We already have the money set aside. We don't have to worry about financing it because if you finance it and you borrow again that $25,000, you tack on your interest. Now you're at $34,000 for the exact same price that you could have just paid $25,000 for and been completely out the door. Now, interesting story. We recently bought some furniture and it was a bigger purchase. We set aside money for it. However, Gardner White and a couple other retailers would not allow us to pay for it, which we could pay for it, but it would be paid at the absolute first or the highest cost. It was going to be a full purchase if we paid for it itself. However, the caveat to that was if we did their financing, they would give us a 25% discount. So not only would we go ahead and do the financing, which once we get the first bill, we'll pay it off in full, but because we did the financing, they gave us a 25% discount on furniture, which if you bought it recently, it is super expensive, but it is a way to save thousands, literally thousands of dollars on furniture just to take their financing for one single month. Because like I said, planning for big purchases, we knew that furniture was in the cards and we were going to have and really go through and buy furniture recently, or we were planning on it. And now we know just paying it off. But again, we saved 25%, which was kind of crazy. Now, number 8, looking at your financial goals. Majority of people that I do financial counseling for do not have financial goals at all. Nothing. Zero. This is what keeps you on track. When you think of retirement, when you think about paying for school, when you think about vacation, when you think of anything, you have to put a goal around it. You have to know exactly what you want to do. And a lot of times if you don't, it's not going to happen. It's not going to happen down the road. A manageable time frame, knowing exactly, hey, by the time I'm 50, I want to pay off this house. I want it free and clear. I want it to be done. I don't want to wait till I'm 49, start planning for that goal in just a couple months. we can tweak the budget, we can adjust our deductions, looking at the savings target, even looking at new opportunities, make a really big difference when you know exactly the direction that you have with your finances. Number 9, using credit cards wisely. If you have to use credit cards, they can be an absolute game changer for your finances if they are used responsible. What we say with responsible is it's not meant to be your emergency fund. That is money that is liquid set aside. The credit card and paying them off in full avoids the interest charge. It earns you a little bit of rewards. And honestly, you can really keep it in check. Now, there are a lot of people in places that say you don't need credit cards. And technically, you don't need credit cards, but there are a few things where you have to have a credit card for. Renting a car, they would not take a debit card. They required and only would take a credit card. When we rented a hotel room or booked a hotel room, they would only take a credit card. There was no option to use a debit card. They were not going to debit. They were not going to hold the money. They would only take a credit card. So I honestly don't know in this scenario if we didn't have a credit card, even though there's no balance, we've never paid interest on the card, having it there for little things. And of course, even if you have a very low limit credit card, let's say a $500 limit can boost your credit score. Credit score is something that they use for everything. If you have no credit score, and I know this is going back to the kind of the Dave Ramsey philosophy, you don't need a credit score, but without a credit score, you will pay higher insurance rates. If you did need a loan by chance, you're not going to get approved because you have no history. If you want to get a mortgage, you can go through a lengthy process to get approved, but if you have good credit, you're guaranteed and you're going to get a better rate than what they would do with port loans and a couple other things. And the final one we talk about in here is building that emergency fund. It is your financial safety net. This is something that gives you the peace of mind when unexpected expenses. Most people that have an emergency fund utilize it, or they have the backup of a credit card. They treat that credit card as their emergency fund. When it comes to car repairs, when it comes to medical bills, when it comes to anything that pops up, they rely on the credit card. Well, guess what? If you drop $5,000 or $10,000 on that credit card and you're paying 25%, well, now you're not only going to be paying back that $5,000 or $10,000, you're going to be paying months or even years of interest on that. So on top of your regular payment, you're going to be paying interest on that, meaning a portion of your paycheck, including just the principal and the interest, is going to be going into that card, making it exponentially expensive, which is the reason why when it comes to having that emergency fund, you have the money set aside. You don't have to worry about it. Everything is already taken care of. All right, guys, so that is going to do it for today's video. 10 financial habits of people who are really good with money, including myself. Let me know in the comments what you guys think, and I'll catch you in the next video. Did you know that 78% of Americans are now living paycheck to paycheck? Breaking the cycle isn't about luck. It's more about adopting habits that lead to wealth creation. And in today's video, that's exactly what we're going to be dedicating it to. And again, if you're tired of living paycheck to paycheck, now is the time to break the cycle. Now, starting with our first one, paying yourself first. This is imperative when it comes to wealth generation. Treating savings as a monthly bill is really a mind trick that you could do where, hey, I have to pay myself $50 every single month because that is a monthly bill and that is the commitment to myself. Now, of course, you can automate this. You can put it at 2%, 5%, 10%, whatever it is, but this is what becomes the cornerstone of keeping some of your income, saving and investing some of that money, and also starting to create the emergency fund. Now, of course, that is going to break that paycheck to paycheck cycle. Might not seem like you have enough money now, but hopefully by the end of this video, you're going to understand exactly how to do it. When you think about the reverse budgeting method, now this, of course, is a method that really ensures consistent wealth accumulation before you do anything else. And the automation that you can do with this removes the emotional tie, removes the willpower that is needed to set that money aside. Looking at our second one, building the budget, building the spending plan, tracking every single dollar, especially if you are living paycheck to paycheck. This is imperative. Looking at your spending patterns, looking at your cash flow, because I've always said this, you have really 3 buckets. 1 is your income, 2 is your expenses, 3 is whatever you have left over, whether it's positive or negative. That is really up to you. Now, of course, to help with this, we have a lot of technology. There's budgeting apps out there. There's financial counselors like what I do that do it for free through my local credit union. But it really goes upon the habit of tracking what you're spending, knowing where your money is going for and what it is going to, and making sure that every dollar does have a purpose. Old kickback to Dave Ramsey right there. Number 3, living below your means. This might take some time. This might take some adjustment. The wealthy consider and really consistently spend less than they earn. Where if you're an individual making $50,000 a year, you can't spend $55,000. It doesn't work out. Regardless of your income level, you might have to pick and choose, what you're doing with your lifestyle inflation, if you're keeping up with the Joneses, and really looking at directing any additional income, if you do have it at this point, towards investments, towards wealth building, towards debt repayment, towards things that are going to be very beneficial for you and you alone. Now, this will shorten and really create a smaller gap when it comes to income and expenses when you start looking at what you're spending and making sure that you are living below your means. Now, number 4, we get into investing early and often. This is the biggest wealth generation in the world, is investing. When you think of real estate, when you think of a lot of other things that you can do on investment perspective, when you start looking at the power of compounding interest and the time in the market, the earlier that you invest, even if it is small dollar amounts, can be an absolute game changer when you start looking at 30 to 40 years down on the road when it comes to investments. Through a diversified portfolio, even using my 3 ETF portfolio, you can dollar cost average, again, taking that $50 that you're setting aside, investing it into yourself, making a really big difference. And number 5, maintaining multiple income streams. This at the beginning is going to be very difficult, but when you start looking at the wealthy, they have multiple income streams, looking at, getting dividends, getting interest, having investments, rental properties, passive income, doing YouTube, DoorDash. There are so many things out there that you can do in a spare time, in a part-time, on a work from home, that can really accelerate your wealth creation and really build the future with new income streams to get you out of that paycheck to paycheck cycle. And of course, it comes up to you for our next one, which is financial education. Exactly what you're doing here, investing heavily in financial knowledge and financial education. We're talking about watching YouTube videos, reading books, attending seminars, following market trends, looking at advice from experts. All of this can be done absolutely free, guys. It's kind of crazy that, a lot of people don't want to have the financial education or don't want to spend the time and effort. They'll sit for a couple hours, they'll watch TV, they'll be on, Facebook, they'll be on TikTok, they'll watch a lot of content, and really most of it's not beneficial. A lot of things that we watch, as much as I love shows, as much as I love social media, a lot of it is not beneficial. A lot of it, you could put your time and effort, really put that dedication somewhere else and make a big difference. And number 7, we get into avoiding bad debt. This is the biggest cycle that I see when it comes to paycheck, is the credit cards. So essentially, we have gotten to really a society where it is all about borrowing. When you think of a car, you borrow money. When you want a house, you borrow money. When you need to buy anything, you borrow money. You want to do a wedding, you want to go on vacation, whatever you want to do, a kid's education. People are borrowing money for everything in the world. Now, when we start looking specifically in bad debt, we are talking anything that's probably north of, I'd say, 8 to 10%. When you start looking at credit card rates in the 20s, 30s, it's insane with the amount of interest. Even when you start looking at personal loans that are 12, 15, 18%, the interest in there erodes your wealth in its entirety. But when you look at some of the better debt, some of it that you're actually getting something for, this is the auto loans, this is the student loans. As much as I don't like student loans and I don't like borrowing, education to increase essentially your income. If you start a career, if you start on a career path, can make a difference. Bad debt is looking at credit card balances, which of course can be very detrimental. Now, if you have a credit card, paying it off in full really does make a big difference. And we can't do any video without number 8, which is building an emergency fund. When it comes to emergency fund, there's a reason why Dave Ramsey teaches it as an absolute groundwork. The emergency fund keeps you out of bad debt. That's it. It is very simple. Again, if you're paying yourself, the financial buffer protects your wealth generation and really keeps you from having setbacks when it comes to finances. If your car breaks down, you're not going to scramble to use that credit card at a 25% interest to buy new tires, to do car repairs of a couple $1,000s, because then all of a sudden that $4,000 you did in car repairs is now spanned over the next 3 years. You're paying around $7,000 for your $4,000 repair, not including any other bills that you have in the meantime. And number 9, we talk about networking. So this is where building relationships with other individuals like myself and ones that are doing really what you want to do. If you surround yourself by people, like-minded people that are positive, that are motivated, looking at organizations, looking at industry events, making you connect with mentors, connecting with peers, Building relationships can open up an incredible amount of doors. It does for me in the banking industry. We do a lot of networking events, and it really does lead to a lot of valuable partnerships within the community, investment opportunities, and knowledge sharing across a bigger, even my YouTube network that I have with the VRA Academy, the Video Ranking Academy. Very cool group of networkers that we do work really building the YouTube brand and building the YouTube image. It's incredibly effective. And if you like the content that I'm putting out, definitely subscribe to the channel. And we get into number 10, which is maximizing that tax efficiency. If you don't like paying taxes like I don't, you have to work with a tax professional. A lot of people think I do all my taxes myself. It's incredibly easy. It's incredibly efficient. You know what? A lot of tax professionals don't charge that much difference when it comes to prepping your taxes, but looking at anything that you can do to not only take advantage of tax advantages, you're looking at deductions, you're looking at contributions, HSA contributions. There's a lot of contributions that you can do that is going to be beneficial on the tax side, which of course is going to reduce your tax burden. Number 11, we get into investing in quality. This goes right back to the value of companies that Warren Buffett talks about. When you look at items, when you look at investing, when you look at things, it is more of the frugal mindset. Personally, I've developed this probably about 7 to 10 years ago, buying things that are a lot better quality. They last longer, they maintain their value longer. And of course, when it comes to purchases, I am not buying them as frequently. Even thinking of my shoes that I wear to work every single day, buying a better quality pair of shoes not only feels better, makes me feel better, but they've also lasted for years. So again, I kind of break it down where if I spend $150 for a pair of shoes, I wear them for 3 years. You know, when you start breaking it down kind of month to month, very affordable in comparison to having back problems, not being able to really work at my best without having something that goes between my feet and the ground. That is going to be comfortable. That is not going to cause me. Number 12, we get into financial goals, setting them very, very well defined with. This is a part when it comes to goal planning, guys. When it comes to financial literacy, you have to have a timeline, reviewing, adjusting on a regular basis. You don't want to just put the some days out there in the universe because most of those some days will never happen. Setting it, and again, for me personally, having the goal to have my home paid off at the age of 50 means that I have less than 5 years to come up with the money to really build the wealth efforts and getting it down, focusing on it over the next 5 years, getting it paid off and eliminated, really breaking down those long-term objectives into little bite-sized pieces that says, hey, if I put an extra $1,000 towards the mortgage, it's going to be paid off in the time frame that I'm looking for, and it's going to be incredibly effective to not have a mortgage. Number 13, we talk about protecting the wealth. Now, this is where insurance comes in. Whether it is homeowners, whether it's auto insurance, personal insurance, life insurance, protecting you and your family is super important. Once you start the wealth generation, you don't want it to be all gone with medical bills. You don't want an unexpected, someone passing away in the family, missing some income there. That is going to create an absolute void. If something happens where you're on disability or there's a liability, you don't want to give up the hard-earned wealth that you're generating when it comes to that insurance. Number 14, automating financial tasks. This is something that I love. When I think of bill payments, it is automated. When I look at investment contributions, automated. When I look at reviewing my budget on a regular basis, almost all of it in its entirety is automated. Really reduces the risk of missing payments, missing investment opportunities, not doing the dollar cost averaging. I actually do it twice a month with dollar cost averaging, making my portfolio just really seamless. Long as I have the money in my savings account, my high yield savings account, wealth building strategy is in place. I am doing my investing every single Monday morning, which I heard rumor is the best day to invest in the market. Number 15 is delayed gratification. This is something that a lot of gurus talk about, a lot of financial investors, a lot of motivation, understanding the value of patience in building long-term wealth. It's unfortunately that patience with the younger generation, seeing the crypto booms, seeing, the YouTube AdSense, seeing the revenue, resisting the impulse to make purchases and evaluate any expenditures on what the impact is going to be on your financial goal. I always go back to my kids because they are in third grade. They are talking about the opportunity cost, where if you buy something, that means you can't buy something else, or what is the opportunity cost of the thing you're not buying, really making and really deciding where they're going to spend their money and where is going to be the most bang for the buck. Very disciplined approach when they start maintaining focus, building on the wealth generation, even at a very young age, knowing the importance of savings, knowing the importance of building wealth, and knowing that the sacrifice for short-term gain can really have the gratification of long-term financial freedom when it comes to living the life that you want. So, all right, guys, so that just gonna do it for today's video, really breaking down the paycheck to paycheck cycle with some proven habits that do really break that cycle if you're using them effectively and using them consistently. So that's going to do it for the video. I'll catch you in the next one. For a lot of people, growing wealth might seem like an impossible task. However, it can be a lot closer than you think. In today's video, we're going to be looking at proven ways to build wealth if you're starting and have practically zero, even if you're in the negative, with our first one, educating yourself about money. Now, when it comes to YouTube and it comes to financial education, it is something that I am very passionate about and I love to do. The strategy is absolutely free. The more time and effort you put into it, and I started doing this about 15 years ago, the more you're going to get out of it, the more you're going to understand the market, you're going to understand exactly how to budget and know exactly the investing strategies, the saving strategies, the budgeting strategies. The easier and the more time and effort you spend into this, the easier it does make it when you do the education for yourself. And of course, if you like the content I'm putting out, definitely subscribe to the channel. But when you start looking at some of the basic information, like what is budgeting? How do you track your expenses? What exactly does that look like? It is the foundation when it comes to building it. Now, second one we look at is getting your employer 401k match. This for me is number one. This is the absolute perfect one. Once you have a little bit of an education, once you have an understanding of what you're investing into, this is where you get your employer match. If they're giving you 4%, take the 4% and run with it. If they're giving you 6, 8, 10, regardless of what it is, 100% getting that match, because when you're getting the match, you are instantly getting 100% of what you put into it. Now, of course, there are a lot of caveats. If you go above the match, if you invest more over, the 4 or 5% that they're matching, that is up to the investments, which of course, when you start that education piece in the first one, can make a really big difference when it comes to retirement. And also, it comes down to you. The third one we look at is investing in yourself and investing in your career. This is one of the biggest financial assets because giving you the ability to earn more money in your current job or even starting something like a side hustle, it is very important. If it is the cost of education, if it is getting certifications, regardless of what it is, if you're making money not only this year, but also making money for the rest of your life, making yourself even more available, more educated, more well-rounded. Training may not pay off today, but training will pay off in the long term. And I, again, have seen that through a multitude of times when I went ahead and built my wealth. Number 4, we look at the automating of the savings. This is huge. When I think of automation, when I think of automatically not only savings, putting money, from my paycheck into a separate account where I have that high yield savings account, but also looking at never touching it if it is just the emergency fund, but also automating everything else. I automate all of my bill pays, I automate my savings, I automate my investing, whether it's going into my portfolios with M1 Finance, which I do have a link down below, or I'm putting it into Bitcoin. It is really imperative. It builds wealth very quickly. That is the reason why 401ks are usually for people the biggest accounts they have, because it is out of sight, out of mind. When you're putting money in your 401k, it is going to sit there. Now, talking about generating money, opening a high yield savings account. This is one we know we've seen rates start to decline. Right now, again, with that M1 Finance, they are paying 4.25%, which is higher than a majority of CDs. And we are talking liquid savings accounts. This is the place you have to absolutely park when you have that emergency fund. When you're building up that emergency fund, it is going to start the snowballing. For instance, in November, I carry about $15,000 to $20,000 in my emergency fund. I got $72. That's right, 72 bucks might not seem like a lot, but for a lot of individuals, it could be. For some, it might not be just but a drop in the bucket. But for me personally, that almost pays my cell phone bill in the entirety, just with the interest that I got for one single month by using that high yield savings account. Now, when we think of the biggest bang for buck, this is when we talk about paying off those high interest debts. When you start looking at credit cards, when you start looking at personal loans, they are usually at an exorbitant amount. When you start looking north of even 12, 15, 18, 25, 30% interest, you are eating up all of the money. And one of the cool things that I've done, and one of the things that I really preach as a financial counselor, is sit down and figure out how much you're paying on a monthly basis when it comes to your interest. How much of your paycheck are you giving away? For instance, if I'm making $20 an hour, I'm paying $100 in interest every month. Guess what? There are 5+ hours every single month that I have to work just to cover the interest that is going to those bills. Makes a really big difference when you start putting it into actually feasibility and putting it into a time factor, where if you're paying $300, $400, $500, $600 a month in interest on loans that you have, on credit cards you have, on things that you have previously purchased, it makes a big difference when you put it and you can visually see it saying, hey, I have to work the next 5 days just to pay the interest for this month. For me, I did this in my master's program and it was eye-opening when you look at how much is in there. And of course, it all starts and revolves around the education of creating and sticking to a budget. Now, I know a lot of people don't like the budget. They don't like the spending plan. They don't want to track what they'd spend. But honestly, when you start doing this, it's going to be a little bit time consuming. Once you continue doing this, it gets super easy and super concise. Me personally, I do use zero-based budgeting, meaning I have a set amount of income, I have a set amount of expenses. Everything that is left has an allocation. It is going into my investment accounts, it's going to my HSA, it's going into the Roth accounts, the IRAs. There is a destination for every single dollar that I have out of every single paycheck. And I do this very simply every single month, because when you think of a majority of your expenses, a majority of them are fixed. They're going to be the same. When you look at rent, when you look at your car payment, when you look at loan payments, majority of those, including your insurance, could be fixed, meaning it's not going to adjust, it's not going to vary. It's going to make budgeting very easy for you. And of course, you can automate this process entirely. There are a lot of tools, like I know Rocket has a tool, Mint has a tool. There's a lot of different places that have a lot of tools that track and really looking at those expenses when it comes to savings and when it comes to budgeting. And of course, the big thing that you also do have to, and I preach this to everyone, having an emergency fund. Sitting down and really having an emergency fund and parking it in that high yield savings account is a game changer. It keeps you from having to borrow. Let me repeat that so you guys understand. If I have an emergency, let's say I need new tires for my car, or a tire blows out, I'm driving home from work, something happens, I need a new tire, tire's gonna run me $300. Majority of Americans cannot come up with that $300, meaning they're going right back to plastic, they're going back to borrowing, they're going back to credit cards, they're going back to whatever means to get that vehicle back on the road. When you have an emergency fund in place, if something like that happens, that is a true emergency. Now, of course, you can't go through and have the justification of everything in your life is an emergency, but if you have a true emergency, you already have the money set aside. You don't need to borrow anything, which again is a really big game changer. Now, also when it comes to financial goals, this is another big part where I had financial goals in my 20s. Really, in my 30s, I solidified them. I wrote them down. I have them on sticky notes on my computer. Making smart goals really makes a difference. Specific, measurable, achievable, relevant, and time-bound. If you really go through and you build out your financial goals, even if you don't break it down to such a very specific systematic approach, you need your goals, you need them written down. If it's retiring at 50, if it's paying for college, if it's buying a home, those goals being visually and being written down in a place that you visit frequently. You could stick them to your bathroom mirror, you could put them on your computer monitor, but the more that you see them, the more you're going to realize them, and the more you're really going to second guess. For me personally, I wanted to go ahead, and I know when I want to retire at the age of 50, I've been saving probably roughly 50 to 60% of my income, and I did this through eliminating all of my expenses. I have one frequent bill, which is my mortgage payment. Everything else is variable expenses, because everything else I can cut costs, everything else is completely paid for in its entirety, giving me the ability and really the goal. I have a very specific goal of retiring. It's measurable. I know exactly what the time bound is, when I'm going to retire, and exactly blueprinting how I'm going to get there. Now, of course, if you want some instant gratification, or really looking at a job, the nominal wage growth year over year, asking for a raise is a way to instantly get and really be able to make and really afford a lot more bills. You can afford a lot more payments. You can afford to save a lot more money. Asking for a raise and really a bump in pay means that you're going to get the exact same, or the same income, just at a higher rate. So if you're making, $15 an hour, they take it to $16 an hour. Guess what? That is giving you more disposable income. You can talk to your boss. You can look at quarterly reviews, annual reviews, see exactly how you can make money in your current situation. And if that fails, which for some of us will, you can start a side hustle. That is one of the big reasons why I started YouTube. All of the revenue that I generate from YouTube goes into that M1 account. It actually goes into a YouTube or a M1 account that I named AdSense. Every single penny that I get from YouTube from this channel goes right into that AdSense. From the memberships, from the super chats to everything that we get, it goes straight into an investment account. That investment account starts growing, it starts compounding. It really makes a really, really big snowball effect. And of course, the one I'm gonna leave you with is opening an investment account. So I wanna run through this really quick just because I have had a lot of people say, hey, I have money at my bank, I have money at my credit union. I don't know how to get it from point A, a financial institution, into point B, which of course is a brokerage account or an investment account. How do I bridge and really make that? So the first thing you need to do, guys, click that link down below for M1 Finance. You can go ahead, sign up, go through the registration process. Once you have that, it'll have you select what you want to invest in. This is where you want to do all of your own research. Now, if you're new to investing, I would start off with probably about $100. Start the account, put $100 in there, play around with it, look at your options, see what you want to invest in. But opening a brokerage account is really the first way. And if you want to, you can also open a Roth IRA that they do have available in there. I really recommend if you can get a Roth 401k, if you can get a Roth IRA, they are going to be the best investment vehicles even at a younger age because you're prepaying for your taxes, meaning future you're not kicking the can down the road and you're not going to have a lot of expenses and tax costs when it comes to later on in life. So guys, I hope this is a very generalized kind of video, but proven ways to build your wealth. And these are tried and true. I personally have done those. There's a lot of financial advisors and a lot of investment coaches that have done the exact same. It is proven when you start from zero. If you have these things in place, it will make a difference. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.